Hello, everybody, and welcome to our monthly Facebook Live. This is Sharon Harold, your retirement coach diva, and I'm so excited about today's guest. I say that every month, but I am really excited about every guest that we have. And this one is no stranger to me. I've been knowing her for 10, 12 years now. And so I'm so glad to have with us Jacquie Smith with JSA Small Business Solutions. Hi, Jacquie. How you doing today?
I'm doing well. How are you doing today, Sharon?
I'm doing great. So I just want to make sure everyone knows to type into the chat your comments or questions you have for Jacquie, because Jacquie is here to talk to us about what's going on this time of year, every year, taxes. We always have to do our tax preparation. And so Jacquie is here to tell us, because that is one of the great things that Jacquie does. And she's been doing for me for several years. So Jacquie, tell me a little bit about how you got into the tax preparation business, or, just some things about your business in general.
Okay. I began practicing taxes at a very young age. I would say I was somewhere between 9 and 10. My dad taught me actually how to do taxes, and I would do them for family and friends. And over time, between jobs, folks would offer me money. So from there, it was dominoes. I have studied the tax laws. I have gone to various trainings with organizations such as H&R Block. I have gotten training with Federated Tax Service. I've gone to Prince George's County Community College to take courses. Very important to I say every other year, to bone up on the tax laws and the tax issues. I have actually gone to seminars and workshops that were sponsored by the Internal Revenue Services. So
Wow.
I've been around doing this for a few years.
Yeah, you said since the age of 10, that just tells us how important your father thought it was for you to have this knowledge, and how you just took it and have grown with it. I know every year when I come to have my tax prepared by you, I'm always scheduling 2 years in advance. So that just shows how your business has grown, and just how important your dad thought it was for you to have the knowledge and start your own business. We should all do that with our children, to start some type of entrepreneur type of venture, so they can know how to have the business, whether or not they decide to move forward with it or not. You still have that knowledge.
This is true.
Yes, yes. So again, please make sure everybody that's joining us, make sure that you share this information out to others, because we want to make sure that we are educating people on tax preparation, because this is tax season and we want to go ahead and move forward. So Jacquie, tell us, why do we pay taxes? Like, I know I don't like paying taxes. So why do we have to pay taxes?
Well, the tax system was designed by the government. And the government decided, when we look at a little bit of history of taxes, this goes back to the Civil War, when President Abraham Lincoln signed it into law. That was our nation's first ever tax on personal income tax to help pay for the Union War. After a while, it was declared, it was repealed. Congress in 1894 enacted a flat tax, but the U.S. Supreme Court ruled that tax unconstitutional. And the following year, because it didn't take into the account of the population of each state. Then in 1909, Congress passed the 16th Amendment, which allowed the federal government to tax individuals' personal income regardless of state population. That required a number of states to ratify the amendment, and it was in 1913. And Americans have been required to pay federal taxes ever since.
Okay, so That's a long time. We've been paying taxes since Abraham Lincoln was president. I didn't realize that it went back that far for individuals to pay taxes on their income. So let's get into the nitty gritty. We know that the majority of us are wage earners. We pay taxes out of our income every time we get paid, whether we get paid weekly, bi-weekly, monthly, even our retirement pay is taxed at some point. So let's go into us as wage earners. We receive W-2s at the end of the year. And I know that we're supposed to receive the W-2s from our employers by January 30th. Now, is that in law that the employer has to issue the W-2 by that date?
Well, it's been stated that most taxpayers have to receive their documentation by January 31st, but it can be as long as February 15th. My recommendation would be that if you have not received your information, you need to start making inquiries. You need to call your employer. You need to call your retirement. You need to call Social Security, and you need to let them know that you have not received documentation. They will get it out to you.
Okay, all right. So when we receive that documentation, that W-2 or that 1099, whatever it is, what should we make sure that's on that information?
Okay, well, your W-2 should have your complete first and last name. Some of them have middle initial. It depends on how you filled out your withholding form, which is a form W-4 when you were employed. It should have your correct Social Security number. Now, let me pause here. If you have a spouse, then if you take on that spouse's last name, you would want to make sure that you have informed Social Security Administration. Because if someone says, well, I got married, let's say in June of last year, and I'm taking on my spouse's name. Well, if you have not gone to Social Security Administration and you have not gone to your human resource payroll office to inform them of that, then guess what? They're going to use the name, your birth name. It's also important to make sure that your Social Security number is accurate, and the dependents that you are going to include on your 1040 form, their Social Security number and last name is accurate as well. I'll go back to saying the other things on your W-2. Your W-2 form should be your employer's name, your employer's EIN number, your employer's address. It should also include the state that you work in, well, where you live. Some states, if you're going to multiple states and working, they may require that you file a tax form with that state. And that state also has its own EIN.
Yeah, that's interesting because some of us live in one state and work in another. So we have to be aware of the tax laws as it pertains to our state of residence, as well as I'll say our duty station state, because I work in federal government. So that's what we say. But so tell us about some things that we need to know as we prepare for, this time of year for our paying our taxes or having tax preparation. You mentioned one thing that I wanted to kind of highlight right now, which was the W-4 form. Now tell us about that W-4 form.
Okay, the W-4 form is considered a withholding certificate. That form is completed at the time of employment. When you complete that form, you're pretty much saying to the employer, I don't mind you withholding income funds for my federal deposit as well as my state deposits. There is a prepared tax schedule that the IRS and others have already come up with. So for example, when you look at that W-4 form, you're going to see that it asks about a filing status. And that filing status for most people who are not married or have a significant a spouse, they would choose single. Now, once you go to the tax table, you would see what the amount should be withheld for a single person. And that information can be found at www.irs.gov. And you can, at that point, type in tax table. They have a search engine. You will be able to see quite a bit of information.
Yes, yes. So
The,
I do know that back in 2020, they changed that W-4 form. And now as an employee, you can't just put down whether you're head of household, married, single, and exemptions. There's some more calculations you have to do. So if you haven't updated your W-4 since 2020, then make sure you go to that IRS website, and because they have help there. So we have a couple of questions that came in from our viewers. Yay, viewers. Thank you so
yay,
much for joining
viewers.
us. Our first question is, can you depend on your employer to use the correct state for your taxes? That's a great question.
No, it's up to you. You are the individual that lives in that state. A lot of us get real excited and we'll just go ahead on. Let's say I have a job in Virginia. Well, the employer, if they are in the state of Virginia, they're going to put down the state of Virginia. You must ask that employer or your payroll person, make sure you're taking out taxes in the state that I reside.
Correct, correct. Now, I'm not as knowledgeable as you, but a little bit I do know is that, again, depending on where you live and what state you work in, there could be that your state of residence and your state in which you work in, both may come out of your taxes, out of your salary. So you need to make sure that you are knowledgeable of the law as it pertains to you, especially if you live and work in two different states. Now, in the DC area, DC, Maryland, Virginia, they have what's called a reciprocal agreement in place. So your employer should not take out taxes. Like, for example, if you live in DC and you work in Maryland, then they should only take out DC taxes. They should not take out Maryland taxes. But I'm going off for something now. When nobody called me asking me tax questions, because I only know a little teeny bit so that's about as much as I know.
And that's true, Sharon. However, if you, the individual, the taxpayer, you must put down your state of residence on that form. Now, again, I have to say that depending on some organizations, they may have an agreement with the state to say, yes, in order for them to do business in that state, it may be some stipulation where the employer must have that state that you're working in with the whole taxes. And when you go to your preparer, you want to let them know that's not where I live. So they will file what you call a non-resident form.
Right, right.
And then that way you can get your withholdings from the state that may or may not erroneously withheld those taxes. And then you file the form for where you reside.
Yes, correct, correct. So we do have another question in our chat. And we also have someone who said, hey, Aunt Jackie, from David Garcia. Now, we have the question from Born Ready. He says, when can you file as head of household?
Okay, we were going to give a scenario about the single person, but that's a very good question. You want to file head of household when you have a dependent. Your dependent can be your child. Your dependent can be your parent. Your dependent can be your auntie, it can be a stepchild, but it cannot be your cousin.
Now, why can't it be your cousin?
I don't know, that's something with the tax laws. They just don't recognize cousins as dependents. But
Okay.
at that point, you may file head of household. Now that comes with some stipulation. The person must be related to you. You must have provided total care for that person throughout the year. Some folks have come to me and say, well, so-and-so down the street said I could claim that child. You don't want to get yourself caught up in that type of scenario. It's always best to keep a clean slate. And there are folks that actually do take care of another person that may be in a different household. Well, let's say their address is not the same as theirs. However, they do provide 100% care for them. That includes paying their home notes, food. I always say the three things: food, shelter, and clothing. They may even sponsor them for school. But at that point, yes, you can file head of household.
Okay, all right, great. That's some great information. Now, I know for me, I have been confused on exemptions and deductions. So can you explain the difference in an exemption and a deduction?
Terminology.
Okay.
It's simple terminology. Depending on what side of the table you're sitting on, an exemption normally is looked at a number. A number could be one exemption for yourself, another exemption for a child or that dependent that you are going to claim. Again, that's all part of the tax table. When you go look at the tax table, you're looking at, I'll go with the single filing status, and across the table, it will show 1, 2, 3, I believe up to 10 exemptions. Terminology is funny because that exemption, when you're talking in terms of withholding, makes sense. But then when you talk about dependents, well, it can get a little bit confusing. So I usually say when it comes to exemptions, look at that as a number that you use to have your employer withhold taxes. When you talk about dependents, those are the folks that you take care of, like your children, your parents, okay, your grandparents. Those, and they live with you. That's the key. Or you provide total support.
Okay, all right. So we have a question that says, if your child is in college, can you still claim them as dependents?
I say yes. If that child is, remember, college is a temporary address. That child's home of record is still at home with their parents. You still provide them food, shelter, and clothing because you're going to pay for their dormitory fees. You're going to pay for their college tuition, along with their supplies, books, laboratory fees, depending on what their major is. But guess what? At the end of the term, they come home. And where are they living? They're living at home. So my college students, unless you're in grad school, or maybe you left home early and you're working on your bachelor's, if that's the case and you're on your own, then no. Parents, you can't claim that college kid. But if that kid is still living at home, or if that person or that child is still living at home and you're providing for them and they are not working, yes, you can claim them if they're in college.
Okay, all right, great. So again, keep on coming, keep these coming. We have Jacquie Smith with us with JAS, Small Business Solutions. And she's talking about tax preparation because we are in the tax season. So we want to make sure that we are doing the things that we're supposed to do. So my next question for you, Jacquie, is to understand how we had that discussion. Let me go back and clear my head. So when you and I were talking, you were saying how there are some things you can claim on federal taxes that you can't claim on state, some things you can claim on state, you can't claim on federal. How does that work? Like, how are we supposed to know? I thought that whatever I could claim with federal, I should definitely be claim with state, because in my mind, federal supersedes state. So how is it that there's some things that I can't claim with federal, but I can claim with state?
That's a very good question. In various, well, let me start on the federal side. On the federal side, there are items, line items, I would call them, that are just given by the federal government, such as, and I'll give you a few. That could be, we talked about education. That could be education expenses that you pay for your dependents. The state may not recognize that. Okay, there are also residential tax credits for making improvements, energy saving improvements to your home. One of the biggest things that are coming out is solar energy. Now, yes, that can help reduce your tax liability, and that will grow over to the state side. But again, the state may not give you as much of a break that the federal give you. Likewise, on the state side, and I'll use the state of Maryland, firefighters, volunteer firefighters, they will get a credit for being a firefighter. However, that credit may not be applicable to the federal. So one of the best things you can do is go to the website and look up your state forms. Okay, the state, you can always go to Google and say, can I write off this in the state of? And you want to make sure that you're saying what state that is. They have the property tax credit. And for my homeowners, or for folks that have purchased real estate, that can vary from state to state. You may live in Maryland and you can get a homeowner's property tax credit based on income. That may not be the same for homeowners in the District of Columbia. You may be able to say, well, when I was living in DC, I got this type of credit. Well, now you're living in Maryland and that credit amount would be different.
Okay.
So there's such things as that. The child tax credit is another credit that goes across the board. So it can be for federal and it can be for state. I usually highly recommend, you can get these booklets online from the IRS. Is the publication 17. That's for individual income tax preparation. And it is broken out by section. I know it's a lot to read, but what you don't want to do is miss out on something that is to your benefit.
Yes, yes. So we have another question in the chat. It says, when are you most likely to be audited?
Anytime.
Okay.
Anytime for any reason.
Well, what's
I
an
have known people.
That was another question. That was the second part of their question. Said, what is an immediate red flag that may think that you might get audited?
Saying that all your contributions go to the church, 100% of your earnings go to the church, or it goes to another nonprofit organization. That's a red flag. That's a red flag. Another red flag is when you want to claim a business, but you can't back it up with the proper receipts. You've been going under a certain filing status for years, and all of a sudden now you're a new business owner. You have to know exactly what those deductions are. There is no rhyme nor reason to an audit. It could be that you got married, okay? And you're no longer using your maiden name. You're now using your spouse's name. But again, if you have not changed your information with Social Security, and let me stick a pin right here, because the IRS do go back to Social Security Administration to validate, and they use your Social Security number and your last name on file. So that would cause a flag. The IRS may come back and say, well, you say this is your name, but you have to prove it because Social Security says it's not. So
Right.
those are things. Audits can be as small as that, or they can be as large as having your own business and you're writing off all of these expenses, or that donation went to the church. All it takes is a letter to validate. You have good records, you can go down, talk to a revenue agent, and they will in turn say, oh no, that's not a write-off. Oh yes, that is a write-off. I was involved in an audit one time where I was working with a client and a revenue agent, and we were talking about meals. And the revenue agent denied my client. And I had to say, let's go and look at the regulation. And when we did, we found out that we can go to the GSA website where it will show you the allowable meal deduction. So it's always a give and take, a back and forth. The best advice I can give is that if you put it on your forms, have the backup.
Sounds great. Sounds great. So we have questions coming in, and I want to make sure that we address these questions. So our next question from Chantel, she says, if you are a self-employed individual, what are your suggestions on writing items off?
A self-employed, well, when you look at the Schedule C, again, go to that publication 17 and type in the search engine, self-employed, small business. There's a list of things that will come up that will inform you of what you can and what you can't write off. It's not going to apply. It's not going to be applicable to every line item, depending on what your business is. And I'll use a limousine driver. We have limousine drivers now by Uber. We have them by Lyft. They're limousine companies. They're cab companies. To me, they're moving folks from one place to another. Well, what can we write off? We can write off the mileage, which is normally calculated by the organization that you work for. And I know cab drivers, because my dad was one, they have a booklet that they have to write out where they pick a person up from and where they drop them off at. Another thing you can write off is advertising costs. If you have your own fleet of limousines, well, you're going to pay for advertisements such as a web page. You have Wi-Fi because you use your phone to call and talk to people. You're on the internet, you're creating flyers, you're buying pens. All of these are advertising costs. So we have to sit down and look at, I'll say maybe there's 30 different areas of things that you can write off. Your office, you have a home office, you have a business office in your home. You can look at that room and take the square footage, which the IRS have already set up a formula and a calculation, and it will take a percentage of your mortgage interest, of your real property taxes, of your utility costs. All of that is pre-situated for you. Another thing you can write off is insurance, licenses. I had a situation where a case manager, every 2 years, they have to go and pay X amount of dollars so that they themselves can maintain their position. IRS asks, well, give me proof of your license. How do I know that you say you do this work? How do I know that you paid X amount of dollars for the license that year?
Right. So Born Ready is he ready? Like he has so many questions in the chat. But before we go any further, I want you to tell us how we can get in touch with you if we have further questions or if someone wants to get their tax prepared by you. How would they get in touch with you?
You can contact me by I have a Facebook page, so you can inbox me on Facebook, Jacquie Smith, Jacquie Smith. You can also call me. my telephone number. Well, let me give you my email address. My email address is jassbs5441@yahoo.com.
Can you say it again and just a little bit slower?
jassbs5441@yahoo.com.
Okay, great. So let's go to these questions because he has a rack of questions. So his first question, or his next question is, what is the difference between marginal and effective tax rates?
That's a good question. I'm not going to sit up here and pretend that I know the answer to that. An educated guess would be based on income. Okay, the tax codes are complicated. They're not easy. A marginal tax rate has already been pre-calculated. Depending on how much income you receive, you have that tax rate, and then there's an added percentage on that. That's the best answer I can give you today.
Okay, all right, well, great. So the next question is, can I deduct medical expenses?
Absolutely, absolutely.
Is there a cap?
No,
Okay.
I've never known there to be a cap. Again, the IRS have already determined that there's a percentage based on your adjusted gross income that you are allowed to write off when it comes to medical expenses. For example, if my adjusted gross income is $25,000, and they, over the past few years, have come up to, if you're born during this period or if you're born during that period, it's normally 7.5% of your adjusted gross income. That amount is taken off the top, and anything in excess of that is a write-off. Medical expenses include dental, vision, physical or mental therapy, medical insurance, mileage, where you have some hospitals or doctor's offices have a parking lot where you have to pay to actually park your car. Medical expenses could be health aids, such as I had to go out and buy a wheelchair. My insurance would not pay for a certain type of brace that I would need. So that expense is something that had to come out of my pocket. Depending on your profession, I may have to buy support hose because I have to stand up a lot.
Mm-hmm. Mm-hmm.
So it really just depends on what it is that you do and what the doctor have prescribed for you. So I know the big thing now is big glasses. It's a fashion look, but guess what? If it wasn't prescribed by a doctor, you can't write that off.
Yeah, and those big glasses with the designer labels on them, they cost a lot, but if you can't write it off, there's no need to just get the regular glasses that's going to be under your plan.
Yeah,
Okay.
the main thing to medical expenses is that you want to make sure that your doctor or your physician, depending on that specialty, document it on their script. Okay. You can say, I went out and bought these glasses because I like them, but they're not prescribed, but they look good on me because they make a fashion statement.
Mm-hmm.
Well, can you prove it? Can you prove that you needed those glasses? If you have a problem reading, get that prescription, go on and get that eye exam and let the doctor write out what your vision is.
Mm-hmm.
And then you can go out there and buy your little designer glasses.
Right, exactly. All right, so his next question is rules of thumb on when to itemize or claim the standard deduction.
Okay, since in the late 2018, there was a change to the tax code, and it was signed by the former President Donald Trump, the Tax Cuts and Job Act. What really went on is that there was an increase in the standard deduction, including the personal exemption. Prior to these tax cuts, there was an amount that you could use for your personal exemption. Well, what happened was they took the standard deduction, added the personal exemption into it. Again, based on your income, if your standard deduction is large enough, then there's no need to itemize. We've experienced folks that at one time thought they could write off or do an itemization, but it was better for them to take the standard deduction.
Okay, all right. The next question is tips on reducing the tax bill.
Don't claim 10 folks if there's not 10 folks there and you're making big money. Other tips could include things like increasing your retirement withholdings. Some people have what they call 401ks. There could be an increase in that. There are tax shelters. Some of the things that I recommend is if you have children, start now by putting money into a savings plan. You can talk to your bank or your credit union about this. That is a tax shelter. I'm not a financial advisor, but if you go to your bank or if you contact a financial advisor, there are tax shelters that will lower your tax liability. Again, homeowners, solar is a big thing, but that's only good for that year. Okay, that can help bring down your taxable income.
Okay, great. So we also have from him, what's the best tax preparation software for people who wish to do their own taxes?
There's TurboTax. Come on now, people. Everybody uses that. H&R Block, they now have online service. There is, to me, no best. I have been satisfied with working with TaxWise. They're out of Rome, Georgia. But as far as tax software, as long as it has been approved by the Internal Revenue Service, you're good to go.
Okay, and on IRS website, I believe they do have a list of their approved online software that they are, you can do your taxes through. So my friend Wendy, she has a question that says, what about those of us working from home due to COVID and increasing your home utility costs? Can we write off that as an office expense?
No. Unfortunately, there is the form 2106 that is supposed to allow you to write off those type of expenses. But again, that's a caveat, depending on what you do. Again, I would highly recommend that you read the publication 17, and you can put in that search area, working from home. Google has a ton of information on what you can write off and what proper forms you can use. I don't know them all, but I do know that there's ways around. The self-employed person is the one that get to write off the majority of those expenses. Some employers have gone as far as to give bonuses for folks that are working at home. But as far as the tax code goes, we would have to go to the publication 17 and do that research.
Okay, all right. So I have a question for you.
Yes, ma'am.
I want to talk to you about, and I'm looking at my notes because I know I wrote it down here, on what retirement income. So when we are working, we have deductions that come out for retirement. Some of us have it where we have a defined benefit and it goes towards that, or we may have a 401k, as you mentioned before, or we might have both. And normally, I would just go for a defined benefit, like in the federal government, or where you might have a pension. Some, when it's taken out, it's taxed before it's taken out. So when we retire and receive that annuity or pension, are we still paying taxes on that money?
Absolutely.
Well, how was that if it was taxed before it was taken out of our?
Well, that's because it was pre-tax, and therefore that money was set aside. It was not taxed. So if you look at your W-2 statement, you will see in various boxes your retirement income. That is not going to be taxed, because keep this in mind, your employer is also contributing to your retirement. There's a percentage that you contribute. There's a percentage that your employer contributes to it. When you are ready, and so therefore that money is set aside and it's not taxed. So you have to look at your forms. When you are ready to retire, you want to say to your employer, I need to complete a W-4P. That is for pension.
Mhm.
And the standard rule of thumb, if you go through that publication 17, is normally 20% for federal withholdings. And I would say a safe number is like 12% for state withholdings. But again, the IRS have personnel that can talk to you about how to go about calculating your taxes for retirement pay. The state government, wherever you live, also can talk to you about that. Don't let these folks get away with telling you they don't know. They do know. And it's also documented in the publication 17.
Okay. Now that we're talking about, retirement income, let's get on that other part that we know, which is Social Security. Now, do we pay taxes on Social Security?
Yes. Okay, so again, the tax code can be really, really complicated. Again, everything is income driven. So for the individual that all they receive is Social Security, they can voluntarily have taxes withheld, but they don't have to, because normally up to, I believe it's the first $25,000 that is not taxed. But let's say you're receiving Social Security and you're also receiving a pension. A portion of that pension may not be taxed, and the Social Security that you receive is on a scale. So a portion of that may not be taxed, but the federal government looks at total income. So if you're receiving Social Security, retirement, interest, dividend, gambling, guess what? They look at the total income. But if you're just receiving Social Security, normally if you have less than $12,000 a year, the standard deduction will wipe that out, and you pretty much don't have to worry about paying taxes on your Social Security income if that's the income that you only receive.
Okay, all right. So we have about 14 minutes according to my clock. And I just want to know what is new for 2023, or as we were filing our taxes for 2022, what is it that we need to know? What's new that came about? What new laws that you may know of that we need to be aware of as we file in our 2022 taxes?
Okay, so one of the things that I am aware of is that the taxes for dependents, the dependent care credit has come back. I want to say the personal exemption has not come back, and there was another update to the tax code that has come back. I apologize for not being prepared to answer that question,
Okay.
but it is in the newsletter that I just provided, and I don't have a copy of that newsletter right now, but it hasn't been that much, people. It hasn't been that much. the current administration, from what I can see, have sort of brought back some of the things that we were able to do. But the Schedule A itemized deduction has not changed much. So for my firefighters, my nurses, all of those nice things we used to be able to write off, uniform expenses, that hasn't happened yet.
Okay, all right. So when people come to you and they want to have their taxes done, or just when someone is preparing to, file their taxes, what should they have in, oh, well, before I ask that question, I have a great question in the chat. It says, have you ever heard of a solo K? And when would this be beneficial for self-employed individuals?
A solo K?
Yes.
I haven't heard that term before. I'm sorry.
Okay.
I'm going to be honest. A solo K. No, I have not heard of that.
Okay. All right. All right.
Now, that might mean something else. Can they be a little more clear with their question?
Sure. Yes, she's going to maybe give us some more clarity on that question. So while we're waiting for that, I just want to know, like, what should a person bring with them to make sure they have when they are having their taxes prepared, or if they're preparing their taxes, what documents do they have to make sure that they have?
Okay, if you are a single individual, no dependents, okay, because again, this snowball can grow. But let's take the scenario of a single individual. They are a homeowner and they have done some improvements around the house that will increase the use of energy. You want to make sure that you have all your statements of income. That includes your W-2s. That also includes any 1099, interest that you're receiving from the bank, dividends that you're receiving from different financial institutions. The individual, if you like to play with the slots a little bit and you hit the big number, you should get a 1099-G. You want to be able to bring that. Basically, most single individuals will have those forms. Also, if they are a homeowner, you should be getting the form 1098 from your mortgage company, and that will show mortgage interest that you have paid throughout the year, as well as your real property taxes. Unfortunately, mortgage insurance premiums was part of the tax cut. I think it's unfair personally, but hopefully with the current administration, that will come back. So those are the basic forms. Those are the basic forms of paperwork that you need to have prepared.
Okay, great. And so,
excuse me, Sharon.
sure.
Also, the single person, again,
Mhm.
if you have dependents, you want to make sure that you have proper documentation for them as well.
Okay, all right, great. So, so Chantel, who asked the question about the solo K, she says it's similar to a 401k plan, but it's for self-employed individuals. And then Born Ready came back and said that 401k plans for self-employed individuals or business owners who have no employees is a solo K. So,
oh, thank you very much.
All right. Well, before we get ready to finish up this evening, I wanted to know if there's any last minute tips or things that you want to tell our viewers are here today.
Yes, I would highly recommend that if you guys decide to, one of the biggest things that I see is donations. Please document your givings. If your contributions are going to your place of praise, normally the church will give you a statement. It's a good idea to have that statement stamped. If you are donating thrifty, some folks like to donate clothes to Goodwill or the Salvation Army. Make sure that those organizations are legit. They give you a form and you take the time to write out what it is you're donating. There are what you call validation forms on the website. Salvation Army donation form. It's just that simple. And it will give you a value for each item that you want to donate. IRS is a real stickler on having documentation. So those are some of the tips that I can give you right off the bat. If you are making big money and you've reached your high scale and you're rolling into a new tax bracket, look at your retirement withholdings and see if you want to increase that. That will help lower your tax liability. So those are some of the basic tips I can say right now. Sponsorships. Sometimes we say, well, okay, we're going to sponsor a child for Christmas. Let's use that. There are organizations out there that you can actually donate money to, and you will get a tax receipt for that. I want to give the child down the street a new bike. Okay, that's nice of you. Can I write that off? No, it was a nice gift that you gave the child.
Okay. Well, Jacquie, I want to say thank you so much for being my guest this evening. We had
You're quite
a lot
welcome.
of questions in the chat. Born Ready says it was a very great presentation and very informative.
Thank you.
Thanks so much for that. He's learned a lot, and I've learned a lot too. And so again, I appreciate you and all that you have done for me over this past 12 or so years that you've been providing me with your great service. And I truly am glad for all those who have been online with us. And again, Jacquie, just before we leave, tell us how we can get in touch with you if we have more questions or someone's interested in your services.
Okay, again, my email address is jasbs5441@yahoo.com, or my Facebook page is Jacquie Smith, JACQUIE. You can drop me, what do they call it? A IM, a DM, yes, and I will follow up with you. Or if you can't reach me that way, you can always reach out to Sharon.
Yeah, and I can connect you with Jacquie. So thank you so much, Jacquie. And everybody, want to let you know that my next event, which will be on March the 8th, at what time? 7:30 p.m. Eastern time. I will be having a guest, and we're going to be talking about cryptocurrency. So we better be ready for that, because at some point we're going to have to pay taxes on your cryptocurrency.
Yes, and I got to learn about that as well, so that I can be ready.
Yeah, so we're going to have John Filippo, who's going to talk to us about cryptocurrency on March 8th at 7:30 Eastern time. So thank you, Jacquie. Thank you, everyone, for joining us this evening. And you all have a great remainder of your evening. All right. Bye-bye, everybody.
Bye-bye.